Fantastic. Good morning, everybody, and happy Macro Monday. It is week 26, and it's Monday the 24th. So a lot going on, given the fact that it's not only the end of the month upcoming, but we're also getting towards the end of the quarter, and we're getting towards the end of the first half of the year. So you just kind of have to bear that in mind with everything we're kind of covering today on the call. There's a lot of kind of structural, strategic kind of things that will be kind of taken through, but you just never know with kind of month-end flows and so on and so forth. So just kind of keep that in mind, how this week kind of plays out. It may cover, I think, a lot of the underlying kind of big structural moves, but I actually think that's kind of a good thing because it means you could potentially get into quite a few of these things. At least we'll see if I am on the right side of things here. Just give me, there we go. I just want to make Raymond over here as also a presenter. So as you can see from the title, we're going to be talking about this huge historic ascent that I think is in the making from gold. Basically across a lot of different levels. We had some key structural breaks last week. We will talk about how I think the implications are for a cutting Fed cycle, hence the embrace of steepeners. And then we'll also start to take a look at 2020. Super early, I appreciate it, but I've made a remarkable kind of 180 U-turn on this, and I would like to kind of share my kind of thinking along that. As always, everything covered here is solely views and opinions. These are not trading, nor investment kind of recommendations. So going through last week, and I'll also paraphrase and add a little bit because obviously we've missed two Macro Mondays. The last one we did was just post the Mexico kind of tariffs that had kind of gone on. I'd spoken to you, quite a few of you on that actual kind of Friday. Was an amazing opportunity to make a lot of money from a cross-asset macro perspective in a very, very short kind of amount of time. And actually a lot of those trades have actually done a completely kind of 180 because just a week later we had AMLO kind of capitulate along with kind of Trump and big kind of reversals there. But at the same time, other aspects of what we're talking about have not. The one that really kind of comes to mind is being short kind of dollar yen. That's continued to kind of grind and break down kind of lower. So interesting to kind of see that. And of course, we have seen continued escalations in the Middle East with Iran. When I was speaking with some of you when I was in Copenhagen European offices about 2 weeks ago, we had the two ships that were set kind of on fire, and going actually back, you had actually the kind of bomb incidents. I believe it was in the port of kind of Dubai. And then what we got last week was basically the shooting down of a drone, Iran saying it was in their airspace and territorial kind of waters, whereas in the U.S. says it was in international. I can't help but playing kind of a bit of a cynic here and just seeing that the U.S. is lining up for a fight, getting its ducks in order to justify a conflict with Iran. We'll touch a little bit more on kind of this later, but I think for Trump, tariffs and conflict abroad very, very much the election campaign manual and gameplay. And it's, I think, very, very kind of smart. From an Iranian kind of point of view, it's very, very tough for the current regime because obviously traditionally regimes such as this always try and act and look kind of strong, and you know I'm sure they are, but obviously against the U.S. it's you know, what is it, a fly to a sledgehammer or something like that? Maybe even that's a poor analogy, a stuck fly on a wall to a sledgehammer. But I would take actually a very, very different view if I was Iran. I would actually be very complacent and open. And actually foster not an aggressive stance. So send that signal out globally. And I'd be very, very interested in how the U.S. would kind of respond to that. This, like, you know, trying to respond, posturing strength with strength is very, very caveman. And kind of, you know, in this case, you know, there's the only clear loser potentially is Iran, and of course the U.S. kind of taxpayer, and of course whatever soldiers could potentially kind of be involved if we do get towards a kinetic kind of you know, situation there. But this is definitely something that in my view is not going to go away. With that said, I will also take the other side of the desk and also say that we've also been getting conflicting things. Trump, to his credit, or as part of his strategy, has also said he's more than willing to speak with Iran with no you know, conditions set on the table. And of course, that's better than not the other way around. Obviously, there's a lot of focus this morning and over the weekend based on the fact that it looked like there was potentially a strike that could have been put in response to the drone 130, 100 to 200 people, whatever it is, could potentially have been killed in that. But Trump, and again, I think to his credit, did not kind of go for it. How much of that is real? How much of that is posturing? Again, a little less kind of relevant. But I still think this kind of conflict in the Middle East and Iran, and it doesn't really have to be about Iran, but in this case it is a big part of his election kind of playbook into kind of 2020, and so are kind of the tariffs. So this is just something to kind of keep in mind. But again, if I was a strategist working for Iran, that is actually the take I would go, is one that's very, very kind of opposite from how we're kind of genetically coded. Interestingly enough, sticking kind of EM, Turkey, Istanbul fell to the opposition. For those of you that don't recall, initially after the elections, Istanbul had gone to the opposition, but it was disputed by Erdogan and you could say his cronies, and they had their election once again, and that was, I think, quite positive, not just for Turkey, for Turkish assets, but also for kind of democracy there, and the signals it's kind of potentially sending to Erdogan. There's a lot of moving parts here, even though I think it should be bullish. We are down about 80 basis points on dollar tri early doors in Asia, which is a pretty decent move. Tri yen up about 96 basis points. You'd have thought it actually should be up more. I think that's going to move a lot more in the near term, given a confluence of different events. But it is worth bearing in mind there's a lot of moving parts when you're looking at Turkey. I think in the near term, we obviously had the downgrade on the sovereigns. Potentially was not a surprise. I would have guessed. But we, of course, also have potential sanctions coming through early, maybe next month, depending on how the G20 kind of goes, if Trump kind of speaks to Erdogan. And, of course, this is tied to Turkey potentially getting this Russian military tech, which I believe they're paid for, which I believe they're receiving next week. And the result of that is, the military kind of relationship they had with the U.S., not to mention NATO, could be really very much at kind of stake. So that's kind of to watch out. At the same time, we know Erdogan is still pressuring the bank to cut. At the same time, we have this big kind of theme that I want to talk about, which should be hugely beneficial to EM in general. So by all means, not really exhaustive there, but we did see some pretty big moves happening in some of the EM spaces, which we will touch on a little bit on FX. The feel and sentiment when I'm kind of back a little bit more on the desk and not getting in and out of flights and meetings is compared to kind of where we were before, we are bullish for equities and bonds. We basically have two major central banks getting more dovish by the second, and you kind of get the feeling that this is the everything up market. Now, we had FOMC last week. I think some of you should have seen the mail ad sent out a day or two before. We had John Hardy's link that I was highlighting that I also had up here. Even though it was a preview, I would still encourage everyone to kind of go back and watch it because it still runs through the scenarios, and that kind of thinking is always something that makes you a superior trader, investor. Basically, some people were expecting we may even have gotten a cut last week. We did not. They abstained from making any kind of cut, but definitely signaling, in my views, undisputedly, that they're going to move in July. Or to put it differently, the hurdle for them not to move in July is tremendously high. We would need some kind of massive beats on non-farm payrolls, as well as a big, maybe unexplained kind of lift up in kind of inflation. And even then, I'm not quite sure if that will be potentially enough. You always have to remember when it comes to these kind of officials, and all kinds of officials, maybe all human beings, it's always a path of least kind of embarrassment, right? Obviously, if I was to argue against a cut, and now the market, as you'll see shortly, is pricing in 100% probability of a cut, with you will see as we get closer, 6 weeks, that people will be starting to talk not just 25, but even 50 basis points. Whether or not that will play out is a whole different kind of thing, but just a few months ago, you could even say a cut was deemed outrageous by some, let alone kind of 50. I think the underlying thing that really said it, at least for me, was the fact that we had Bullard abstaining, right? He was one of the voting members, and he actually advocated for a cut last week. And I believe up until then, everyone has always been with the consensus kind of view by the FOMC. And then, on top of that, cash, get me the Fed chair job by all means and all ways. Something that I've flagged and we've talked about before on Macro Monday. He was a voting member last year, hugely ambitious, very young, ex-Goldman, I believe also very a governor, or at least very, very kind of high-level also official before. He's basically arguing for a 50 basis point cut. There's no one that wants this job more than Cash Carey. I just love the name. It still cracks me up in this kind of QE world that we have a Fed official called Cash and Carey. So what does this mean, FOMC? This basically means that, we had Draghi speaking on the hoot once or twice. I think last week we had the same thing from RBA's low. The race to the bottom is on, people, right? In regards to he or she who has the weakest currency is going to be deemed to win. I think the most significant part of this is, even though we kind of had that game playing out, it did not really get as much weight, cause as much ripples, given the fact that the Fed was moving the other way when everyone else was kind of neutral to kind of cutting. Now we basically have an FOMC and a Fed that is going to be cutting. The question is, are they going to be cutting aggressively? Is it going to be a one and wait, etc.? I think it'll be a little bit more kind of gradual, but their ability to cut, not just from magnitude in regards to kind of room to cut, they have a lot more than anybody else in the developed markets perspective. Fed's sitting at 2.5. I think off the top of my head, the next biggest is maybe RBA and RBNZ at 1.5. I'm trying to think where Bank of Canada is. See, that's what happens when you leave the desk. So we got Bank of Canada at 175. So Bank of Canada is probably the biggest. And we actually have some interesting divergences that we've also flagged here before, likes of Norway, likes of Poland, likes of Hungary. So we're talking the zloty, we're talking the HUF, we're talking the Norwegian kroner, and I think we're also talking the loonie for a while. That's very, very different from the variety of kind of moves that we're seeing. And also we could be seeing something different with the Kiwi dollar as well as the RBNZ, which is obviously on this week, but we had really big beats on Kiwi first quarter GDP coming in at 2.5 versus 2.3 that was expected, and maybe even more importantly, we had revisions to the previous fourth quarter 2018 GDP going from 2.3 to 2.5, right? And we'll also look at the probabilities for the RBNZ this week and the RBA the following week. Net result of all this, and there's actually one other thing I forgot to mention. Again, so much going on. We had Trump and Xi apparently having a very good phone call, and looks like they're definitely going to be meeting at G20. That was also something that was kind of up in the air. And we started to see a very, very big breakdown in the yuan. So I almost kind of fell off my chair when I was just kind of going through the currencies. And thought it was a typo when I saw that dollar CNH is basically at 686 compared to kind of the 693, 694 levels that we were kind of knocking on. Is that good for a Chinese economy and exports? Of course not, but interesting still to see that kind of big divergence. Moving on to kind of asset class basis, vol pretty much unchanged on the equity kind of side of things, degrading, or should I say degrading, going lower in regards to kind of bonds as a whole, as well as also kind of credit spreads. Equities pretty much a sea and an ocean of green, one exception being Nifty. Wonder if that is maybe the big kind of influx and move that we saw up higher in oil, but you can see very, very healthy kind of strong moves. And FX, big move lower in the DXY and the US dollar. Massive week for the euro, 144 basis points. Dollar yen, which has been a little bit more moving down over the last few weeks. You got to remember, we were at 109.50 levels, right, before the original tariff tweets on Mexico. So again, another big move there. Going back on the DXY and moves down, over the last 3 weeks, we've had two moves that have been over 100 basis points. I believe the one before was, last week was positive, and the one before was something like 150 basis points or something like that. You have to go back to the start of 2018 to see something similar, and again, off just the top of my head, I think it was only 2 data points. So this is pretty significant in regards to what we're having here. My view and my kind of thesis, and we'll look at a few DXY charts later, is we're basically at an inflection point. We are going to be systematically and structurally moving lower on the USD. massively positive for EM, massively positive for especially EM, FX high yield. Makes stuff much difficult for the BOJ and I think the yen. So I still think we see 105 before we see 109 and a half. And again, makes things that much more complicated for ECB and Draghi. And you'd see the technicals in the euro really look like it can go a lot higher. Commodities, obviously, weaker dollar should lift the entire space as a whole. We have seen decent lifts in energy last week, again, given the continued escalations, and we at least have heard from Trump that we should be getting further sanctions in Iran. That's his potential kind of response. They're coming out this morning. Early doors Asia, we're basically up about 60 and 70 basis points on Brent crude and WTI, up about 18 and 22 basis points on E-minis and NASDAQ kind of 100 futures. Down a touch on DXY, not too much kind of big moves on the currencies. Interesting, though, to see Aussie up about kind of 40 basis points. And, of course, try kind of liking the news kind of coming out of Istanbul. But what I think was most kind of pivotal from an asset class basis and commodity basis, what we're seeing in gold. Massive breakout higher. We, I think, have shaken off the very, very tough gold stance where we had at the start of the week, where we had false breaks to the upside, false breaks to the downside, and it was very, very tough to play anything kind of tactically. I'd spoken with quite a few clients who luckily had the mandate to have a lot more kind of medium to long-term kind of perspective, so they looked at stuff like GDX, calls, leap year kind of calls, very long-term, or just had a much smaller kind of underlying kind of position. So this break is historic, and we'll kind of look at how I think about it kind of around now. We're about 14.05 with gold this morning, up about 45 basis points. I think actually silver has a better kind of skew from a risk kind of reward basis. And again, that's also because I'm still in the global growth is slowing down. It's managed. It's not falling off a cliff, in which case, obviously, then that could be quite big. Again, there's so much I could go on in different asset class, but let's just kind of get cracking and moving on to different things that are going on. This is from Oleg coming through. You could see massive move lower on the U.S. dollar. And bear in mind, this is pre-FOMC, right? So net longs in USD down about kind of 30 basis points. It looks even more significant on the chart, which I don't have here, but when it shows you kind of net longs in the USD versus kind of everything else. I'd expect this week is a little bit tough because, again, we have month end, weekend, quarter end, first half end. So it may be a little bit kind of noisy this and next week, given the fact that it's only going to go to Tuesday. But potentially when we start to get into kind of second week of July, we'll get a much kind of cleaner side. And I'm very much of the view that this is quickly going to be getting to zero and then into kind of negative territory, and we're going to be making, new relative 2-year maxes, extremes, shorts in the USD versus a lot of these other kind of currencies. You could see massive reduction in euro shorts, as well as some of the other kind of crosses there. Interestingly enough, market's still short sterling, despite the big moving kind of cable last week. Same thing, I think, in commodities. Again, not going to go through everything here, but the most exciting thing is, I think, what we're really seeing kind of in the precious metals. You could see the massive move to kind of cover silver, right, that kind of occurred last week, and, of course, a huge kind of spike on gold. And relative to kind of 1 year, we are basically sitting on max. I'd expect this to kind of explode upwards. Right, so that should kind of be going. And the breakout we have in gold is something like 6-7 years from a price kind of perspective. A lot of different moving and interesting parts in the commodities, especially in some of the soft and some of the agris. I definitely like to think of looking at them from a long skew. I think the net long positioning in commodities is going to continue. I think you can kind of have the caveat of not really needing to appreciate the supply demand as much as you normally would, just because I just think there's going to be that much more tailwind from a structural kind of decline in the US dollar, at least if my kind of thesis and idea keeps on kind of playing out. This here was just basically what was being shown from the FOMC statement. So this here was the May, this here was the June. The color is basically kind of the delta. And two things really stand out to me. One was they took out patient in June. making it potentially more imminent in regards to them wanting, being able to do a move. And then here was the abstaining from basically Bullard on 25 kind of basis points, right? You could see now for the July 31st meeting that markets pricing in a cut of probability of 100%, at least according to this way of measuring interest rate probability. But you could see 30% of that is actually for 50 basis points cut. So we're sitting at 250. So 70% is we cut by 25, we go to 225, and 30% is saying we cut by 50, right? And we go to 2, right, on the upper end. And now you can actually see towards the end of the year how that extends, where you actually have people now talking not even 3, but even 4 cuts, right? Which is quite astonishing, right? Because that's basically talking 100 basis points. So this is kind of food for thought. The lines kind of give you a little bit of a sense, but the huge kind of shift that we've kind of seen kind of going on here. So I'll correct that on the actual deck. So I'm going to do week ahead, but what I really want to focus on is these 2 slides, right? That's kind of main kind of thinking. So week ahead, as I said, could be a lot of kind of month, quarter, half-end floors. We got RBNZ. We got, I believe, flash PMIs and US PCE. Actually, flash PMIs may be wrong. I think we had that last week. So PMIs should be coming out next week. But we do have US PCE. We should also have personal spending and income, and we should have also final GDP. G20 is really going to be the key focus this week of what everyone's going to be watching, as well as people still digesting the FOMC from last week. I was very, very shocked by how many people looked at last week's FOMC and just said there's nothing happening. Like, make no mistake, last week was huge and is really, really big, and it's not over by any means necessary in regards to kind of what's going on and kind of what's happening, right? Continue to watch Middle East and Iran, even though it may get a little bit kind of quiet. But again, Trump has been known to posture around kind of key meetings. So some tweets going into G20, at G20, post G20, we can kind of expect to kind of happen. RBNZ, market's not expecting any delta this week. We'll look at a few kind of probability charts. Bank of Thailand, interestingly, nothing there. Ditto on Mexico. RBA is next week. Again, economists not expecting anything, but the actual implied probability you'll see is larger than the RBNZ. It's something like 20% expecting a cut for RBNZ this week, and I believe 70% currently expecting for RBA. Nothing really on the Fed speakers, except obviously watch for Powell. Low, we already had speaking a few times last week saying, don't be surprised if we cut. So that's definitely opening. And no real kind of comments on the economic kind of side of things. So my overall view is very much this. We're about to embark on what's likely going to be a Fed cutting cycle. It's going to be happening on a backdrop of slowing global growth. This is a very important assumption. I'm not talking about global growth falling off a cliff, but managed. So very different from a GFC. Now, this is basically cascading into a restful bottom theme, as well as a thirst for yield theme that will come back with a vengeance that we've never seen before. So what I'm trying to say is the record low yields that we saw in 2014, or 2016, I believe it was, when we kind of got to kind of 135-ish handle in US 10s, we're going to surpass that in this kind of regime, right? So I'm looking for eventually structurally all-time lows to be seen in bond yields and volatility, as well as all-time highs to be seen in equities, bond prices, precious metals, potentially commodities, even though obviously it's a broad kind of bucket, but again, just that weaker US dollar is really, really going to help that space as a whole, and then as well as illiquid markets, right? Again, this is based off of the Fed continuing to ease, ECB not wanting to be caught with a stronger kind of currency doing what they can kind of do, and I think that they will move at their next meeting, which should be June 25th, and they will try and do something. There's no doubt about that. And for those of you that say there's nothing they can do, preach. Take a look at Japan and see what's going on there. And the next ECB is July 25th. And I think the net result is more, again, money into the system, more valuation increases in your private equity and venture capital, and real estate with some notable exceptions. So overall, it's move lower in yield. Overall, it's structural move lower in the USD, which net should be quite positive tailwind-wise for the rest of the world, EM specifically. Now, tactically, you may think that we moved far too quick. I think you may be potentially right, but I think strategically you want a core position in these big kind of themes that I'm talking about, i.e. yields going lower, precious metals going higher, US dollar going lower, whether it's just an outright DXY short or a basket against US dollars or a divergent kind of basket. So long NOK, long CAD, long Zloty, long hoof versus, let's say, short Euro, short USD, etc. Right? And I think these trends, again, I can't emphasize enough. I really think we're at the inflection point, and there's a lot more to kind of come through. Markets not yet there. Key risks to obviously this view is inflation and growth coming roaring back out of the U.S., China, and Eurozone. Definitely low delta, I think, on these three, especially Eurozone as a whole, probably has to get a lot worse before it gets better. Only thing that can really save us is not monetary policy, but it's fiscal policy, and that is anemic to the Germans, and we need it for them. And I think China as well, we know that things are maybe not bottoming out as quickly as we expected them to a month and kind of a half ago. U.S., probably the highest delta in regards to any kind of roaring back, but again, very tough. Given where we are in the election cycle, we're a little bit away from 1 year. We already know that, Trump, I think, announced that he's kind of going down through it. So there's going to be this amazing kind of game that both sides will kind of be playing. So hard to really see anything, at least of a fiscal nature, that's a big mover coming through, unless we all of a sudden get a lower turn. And to be very honest, the U.S. data is not abysmal. I know everyone kind of keeps yapping about the last kind of jobs report, but please, it's definitely not falling off a cliff. And again, it's really about the moving kind of average, which is still very strong for where we are in the cycle. Another key risk is, of course, a more imminent recession, some kind of systematic shock, risks to growth. This would obviously lead to risk off. Would still be phenomenal for the core long bonds, basically lower yields trade, but not so great if you got a long US dollar kind of basket, right? Because in this case, on massive kind of risk off, imminent global recession, USD gets this kind of bid flight to kind of safety, as of course will the Swissy and of course will the yen. And now a very strong point on US 2020. This is also kind of potentially a key risk to the everything goes up world. I now have moved from expecting Trump to win to very much now expecting him to almost absolutely lose, right? Which I just have realized is not what I've written here. But basically, I was moving from an absolute kind of Trump win, and I will obviously correct this in the slides, and I've done a complete 180 about this. I actually don't think it's about the Dems. We can laugh all we want about them being 26 plus. We can laugh all we want about Bernie and Warren and just people just picking things out of the air to say that they will deliver, and MMT, which is neither modern, it's neither monetary, and it's neither theory. It's just collective socialism, if you will. But it's actually all of that is going to be irrelevant, because it's going to come back down to what got Trump in last time, what basically gave Trump the edge, and that was just simply there was a big enough camp that just did not want Hillary. They could not give a damn about the facts. They could not give a damn about the rationality. It was all kind of emotional based on how that system kind of works. They could definitely take a page out of the Australia system, and that was it. And that's how it's going to be in Trump at the end of the day. And don't get me wrong, if I was a strategist, I'd still be all about, yes, cause conflict on the tariff side, look like the strong man at home, continue to window dress stuff, no one goes into the second or third derivative or looks into the details, and, continue to engage in conflicts in the Middle East and such, right? This is basically just a page out of the Bush's presidency and why the U.S. And much of the Western world got entangled in the Middle East and Iraq in the first place, right? And it did help Bush go into kind of a second presidency, because it's very hard to attack, if not downright impossible in the U.S., a president that has a conflict, because it becomes now a question of patriotic, very tribal, very crude, but highly kind of effective. Anyway, bottom line, I think Trump loses. And if Warren comes in or Bernie comes in, we're basically talking probably 20-30% lower in S&P, right? The market will start to focus on this, notably next summer. But just keep this kind of in the mind in regards to kind of key risks to this potential kind of view of things kind of moving lower. Because what it would imply is massive spending if a Warren or Bernie kind of comes through, at least if they're going to be undertaking what they're talking about, where everything is basically free for everybody. I'm paraphrasing a little bit, and I'm not trying to pick Dems over Republicans or anything kind of like that. I just think most of Wall Street, most of my peers think Trump is a slam dunk win. I don't think that's the case at all anymore, so I've completely reversed that. So take that into your calculus. This I'll kind of clean up. I was just running out of time, so I'm taking something out of my global macro kind of journal. I'll clean it up for the actual kind of deck, but it does give a little bit of a view in regards to kind of what's thinking top of mind, right? So again, these are my views. Most of them potentially could be very, very wrong. Some could be right, whatever. Current thoughts and consensus views at the moment. Equities topsy. We've had that for ages. Bond levels expensive. We've had that for a while. I've been the one that was thinking we were tied at 240, and of course we got sub 2% on US 10s last week. Crowd thinks Fed will cut on July 31st. Crowd thinks Trump will win 2020. Crowd does not believe in inflation or growth pickup. Most of crowd is probably global recession camp. I think that's why the USD has been bid for most of the year, and dollar CNH to go up. Don't think that's necessarily kind of the case anymore here. Where do I think consensus thinking and positioning is in 3, 6, 9 months? This race to the bottom, I think, will become basically part of everyone's kind of DNA. Reduced US dollar, increased precious metals, all-time highs in gold coming, increased EM. I think EM outperformance versus DM, increased yield plays, dollar CNH to kind of come back down. Consensus positioning. Now note, positioning and views are very, very different. Crowd's still very long USD. Crowd's still very long bonds. Crowd's not a record long precious metals yet, at least from a historic basis. Yes, from a 52 weeks basis. Crowd not record long commodities. Crowd not record long EM assets as a whole at all. Risk parity continues to play out. Now remember, just because positioning is one way does not make it wrong. It's just something worth kind of looking at. I would probably also add here that consensus views is also volatility not going up, but I'm not quite sure volatility going down is a consensus view. That may actually rub quite a few people kind of the wrong way because, of course, they will argue it's so low. But my whole view is monetary policy sunk volatility, it sunk yields, and that's the regime we're going to be in for the next 12, 18, 24, potentially 36, maybe even 5 years, right, before we get sucked into the next kind of global recession. So what are the implications of structural Fed cutting cycle driving a lower USD to global economies, to other currencies, to bond, equity, commodities in the market? Again, by no means exhaustive, but this is EM. Headwind is now a tailwind. U.S. exports to flourish versus importers, right? Because obviously your goods are cheaper now, so there's a basket kind of trade there. USD on offer. It's been previously on bid. Bid on obviously yen, euro. Bid on EM. 2 times bid on EM high yielders, EM FX carry. Commodities bid across the board. Super extra bid on precious metals. Again, silver I think has a much kind of better skew. Bonds, again, cyclical bid. Love it or hate it, but you know this has been the best asset class to have a career in. EM bonds even more, I think, bid yields to make all-time new lows, which is astonishing. But yes, if you think we were at crazy negative yields before, you have not seen anything yet. And I think what most people want to always know in equities, you know, they're going to end up being bid due to yields, right? Biggest risk here is, of course, FOMC not moving in July. And again, that theme will move to other kind of businesses. For those of you that have private businesses, cash flows, etc., it's king. I would just not be selling anytime soon. And again, volatility to make new all-time lows. This is just a little bit of rough on the thinking here. We got US dollar, commodities, gold, silver, bond yields, equity levels, vol levels. This is kind of my thinking here today. This is all very back of the envelope and very general, folks. 6 to 12 months from today, I basically think these are the trends, and potentially 2 to 3 years from today, right? With some exceptions, maybe in the sense of real estate in markets such as Australia and Canada. And again, this is also assuming that global slowdown is managed and is not done through an abrupt kind of unsystematic shock downwards. Going on to kind of ideas, positioning-wise, and skews of the book, as we said, a basket of U.S. exporters versus importers, EM outperformance, spread plays, Japan to kind of lag what would happen maybe in the U.S. and what would happen in EM, again, just given the yen being bid. Eurozone potentially to maybe lag last, just because, again, I think ECB doesn't have the room to play the game that the Fed could play. Basket with short USD names. This could be DM based. This could be EM high yielding based. This could even be a commodity kind of based basket as well if you want to try and play that extra commodity uplift tailwind. Steepeners, not just in the US, yeah, globally, but I think we'd have a massive move here. And then you could also look for eventually, I think, a turnaround on CAD and Bank of Canada side, but that may be late third quarter, early fourth quarter. We have to kind of wait and see. And go back to kind of 2014, everybody, because mid-2014 was when the Fed started to basically signal that they were going to be hiking, and that's when DXY kind of went from kind of 80 to 100. I can't remember if it was 105 or what it was we got to, but we're now at these 96 levels. I'm not trying to say we have to go back from 96 to 80, but I'm trying to say there's huge margin of safety in regards to kind of pulling back. And actually, when I was looking at a lot of the charts over the weekend, the one that seemed to have the best skew to me, again, assuming my assumptions are correct, was a weaker US dollar. It just seems like there's just a lot more kind of downside on that than a lot of the other things kind of there. As always, it's best to kind of have a few kind of cross-asset views rather than just kind of one thing. So that would be short DXY or short some kind of dollar basket, right? A few other things, these a little bit maybe more tactical in near term. We already talked about further sanctions in Iran. This could be oil positive. We're bid up still about 40, 60 basis points. We're definitely not starting the week off on risk off, at least on U.S. equities and commodities, but we are, and even on currencies, but we are definitely seeing risk off a touch on Asia kind of futures, right? And again, a few things, risk sanctions on Turkey, maybe less sanctions, better relations on U.S. kind of Russia, things to kind of watch out for over here. And then, of course, kind of the usual summer spiel, liquidity, summer in the Northern Hemisphere, people off, July, and then August, as we know, whole of Europe kind of goes away. Definitely kind of things to kind of keep in mind. But again, the underlying point is I just don't think people realize how pivotal last week is and the changing kind of regime that we're kind of in. Right. So please take that as you will with you. One more slide, I believe, before I pass it over to Raymond for Greater China Take. This here is just now talking about New Zealand and Australia. New Zealand, obviously, this week, 22% is probability of cut. Australia next Tuesday is 76%. We have here is 4 hourly, daily, and weekly kind of chart. You'll be able to see this better on the kind of the PDF. But net, what I'm basically trying to show here is on the 4 hourly and daily, it still looks like Aussie Kiwi kind of to the upside. I am looking for time to kind of get short or start to building some shorts because I still think we have the outperformance of the Kiwi versus kind of the Aussie. Still think Kiwi fundamentals better than Aussie fundamentals, and I still think RBA is very, very much behind the curve in regards to having moved. With that, let me please pass it over to Raymond for some further takes on Greater China. And we are looking for Raymond. Okay, Ray, I have made you a presenter. Can you connect your mic? Okay, we seem to be having some issues on that, so we'll get that sorted up for next week, but I'll just move it on then for now. So Just going to some charts. So this is underlaying everything that we've kind of talked on. So I may skim through these quite quickly. DXY, again, this is the daily. This is showing the significance of the big break, and you can see pretty much up until then we were basically consistently making higher lows and higher highs kind of as a whole. Bear in mind that I basically have been expecting US dollar weakness from the start of the year, so for pretty much most of the year I have been wrong, and I think it's because most people were in, the market was basically in this kind of imminent kind of global recession camp, which I just never was and have kind of believed in. So we broke through 100-day, we broke through 200-day. With this kind of key 96, you can see MACDs and indicators pointing towards kind of the downside. Now here we basically have the weekly. You can see, the key level that we kind of struggle to consistently kind of break above or stay above was kind of 97. Had a few weeks of that, but we're now basically hovering at kind of this 96 levels, which is basically kind of 200 week. And I would expect us to break that. Again, this week may be different given what's kind of going on, but I would expect us to break that over the next kind of 2 to 3 weeks quite strongly. The easy money and the easy quote-unquote move is going to be to kind of 94, but let me just take out a monthly chart. And this kind of shows you, again, 2014 is where I'm taking it for. We're up about 20% from where the Fed started to signal that they're going to start hiking. First hike came in actually DEC 2015, right? Which is quite astonishing if you think about it, right? I mean, we actually moved more than 20%, right, to that DEC 15, which tells you how much things can move before the actual event, how much the market can actually price in. So I think it's not aggressive to be short from 96. You could have a stop or be able to kind of hold or pull back to recent kind of highs, but targeting a tactical clip at 94 to reload if we move back up, maybe a core clip at 90 to kind of 86, 90 for the kind of the final thing. All right, I'm not necessarily advocating you should play back to kind of 80, but in the case of things kind of getting worse, we could easily move a lot lower on DXY. So, and by getting worse, I mean Fed may be kind of getting more aggressive. The key risk, as I said, to this is, I don't know if we have an even longer term chart on this. Yeah, all right. The key risk, though, as I said, is if we have kind of an imminent kind of global recession, systematic shock, then the US dollar kind of gets bid very aggressively. And if you go back on the GFC charts, 2008, I believe, the dollar index did something like 25% in literally the space of a few quarters. So that's a key risk and thing to kind of just keep in mind. And if you have a different skew of me, then you potentially do not want to have that kind of short dollar view. Again, this is a pivotal key weekly breakup higher in euro dollar, up over the 200 week at 113.5. Most people will be watching 115, just psychological, but really it's about the 100 week 116.77. I would basically be skewed towards playing, looking to fade euro crosses and euro dollar crosses into ECB, but that is still July 25th, so that's still a lifetime away in the world of kind of macro. Risk is that we potentially continue to kind of squeeze higher. So I'm just kind of watching that kind of cross. Yen, again, systematic kind of breakdown kind of continues. This was beautifully called by yours truly on that day of the tariff kind of hikes. Again, I think 105 easily before 109.20, 109 and a half, let alone even 110. And before all of this is out, we'll be getting to 103, 100 is kind of the view I'm seeing kind of there. Aussie, it's a little bit trickier now, and I was speaking to a few people about this. I do have a mail on Aussie specifically for those of you that may want. I still think the structural move lower is going to be happening. We could see a little bit more inconclusiveness on the indicators, but I would say that it's to make all-time new lows. Again, obviously 67.41 is the most recent kind of weekly kind of low, with probably congestion wood being around kind of 70 cents to 70 and a half. 74.30, I mean, I really struggle to see us getting anything kind of close to this. So I would actually only expect a figure and a half more to kind of continue up. So with that, Moving on here on Kiwi. I think this has a lot more tremendous upside than Aussie. To be very honest with you, we may be getting a little bit subdued today given RBNZ this week. We also have a little bit more data on New Zealand this week. We're up about 6 basis points compared to the Aussie, 33 basis points. And the key kind of resistance is 69, right? And I think probably the skew here in regards to recent lows is likely something that we're not going to go back to kind of retouch, right? So I kind of really like this from the long side. Looking to put this on from the short side. Think we go back to make all-time new lows. Definitely go back to challenge the parity kind of handle, which will tend to receive a natural kind of bid. But I think we'll take out these kind of 102, 103 kind of levels that I believe we kind of got to early on. So again, this looks like a nice skew towards the downside. If I'm correct about RBNZ more on the side than the RBA, and if I'm correct about Kiwi fundamentals being better than Aussie kind of fundamentals, this I think is to me one of the most interesting crosses in the world. Naki, like astonishing. So obviously we got the hike last week. We've talked about the divergence play on the Norwegian krona. A lot of you have heard me discuss this many, many times. It's not, to be honest, being the easiest play, but I think now you're seeing the kind of the big breakaway on it. So this here is actually dollar Naki. Normally it's euro Naki that we kind of have. That still kind of holds. And you can see we're in the start of something that I think is going to be beautiful. Beautiful, beautiful, beautiful. Easy money is to kind of 8 to 824. But I think structurally even longer you could be focusing maybe on the 7 to kind of 750. Obviously near-term risks, the Middle East, oil, etc. Looks like we will potentially get one more hike in September from Northbank and potentially another one later on kind of next year. On that same kind of thinking, and you can also see the indicators here just getting kind of cracking. On that same kind of thinking, we have the zloty, which is something else I've talked about. Remember we were showing euro zloty early on this year from kind of 430 levels, targeting 425, 420. We've gotten to kind of 425-ish kind of levels. But this year's dollar zloty, again, I think a lot of potential for a lot more kind of strengthening. Lower, again, on the divergence economy, divergence kind of central bank kind of basis. Same thing on the hoof. And again, the idea is to go in, do the works, check out the last central bank kind of statements, where inflation is, where kind of growth indicators are. But these were all things that were on my radar from a relative outperformance towards Eurozone as kind of as a whole. Euro zloty again here. So we were talking about it kind of 730-ish early on in the year. And yes, I know some of you will say it took forever. But, hey, it is kind of what it is at the end of the day. This was the easy move. I'd expect us to continue to kind of 420. The interesting thing is this cross always seems to do better when the euro kind of rallies, which is quite fascinating to me as well. But again, would prefer this on kind of the zloty kind of side versus the USD. But if you don't want the USD, then euro is fine. I'm watching Euromex. This had a big move up higher last week. Interestingly enough, we're actually seeing it kind of bid towards versus, let's say, dollar kind of mex. Again, I'm loving the carry on this, especially if I'm correct. And ECB cut in July. I think this could be a kind of multi-quarter, if not multi-year kind of trade to have, because I think we end this year with EMFX having potentially the best outperformance as asset class in many years, and that could actually run for quite a bit. So I'd watch that. Euro NOK we talked about, again, despite the big move last week. I think from a multi-year basis, there's a lot more to kind of go through. Remember, a big chunk of 2014, 2015 was just oil getting absolutely obliterated, right? And that's just not the case that we're seeing kind of right now. This here is telling you why the breakup higher in gold is so key and pivotal. We were starting at the beginning of the year, and then we kind of had this basically very frustrating range to kind of trade either on the long or the short side from the tactical kind of perspective. 1350 was really the big level to kind of get over, and we got a massive close last week, and this opens us up for a lot more upside. We'll get to a longer term chart on gold briefly, but this is why you could see I think silver offers even kind of better prospects from a risk kind of reward skew to be honest. If I had to pick one, I'd pick this. And if I even had to pick proxies, I'd probably prefer something like GDX, GDXJ, or SIL, because at least you get also a yield, and you get paid to be long while you also wait. But given the move that we've had, I would be careful about kind of potentially kind of going all in just from a tactical kind of perspective. But I think there's a lot more in these breaks to kind of come through. This here is the multi-monthly chart on gold, again showing you how significant this break is that we're in the midst of. Obviously, we've not closed on this month, right? But if we do close above kind of 1350, which is the 100-month moving average, and has been the key kind of level that's kept us submerged since 2016. You can see you got to go all the way back to kind of 2013 to kind of break this through higher. I still am shocked that people are just not paying attention to it. So again, this is huge as it's kind of happening kind of now. And I think this should be the last slide. This is basically steepeners. I'm saying embrace the steepeners. We're going to have a massive move. This is 2s versus 10s. You could see where we were 2014 before the market started to kind of price in that, okay, it's going to be a Fed that's going to be hiking and flattening. And I think we could see a very easy move, definitely to 50, 75, and then kind of the last chunk kind of being to kind of 100. And as you can see, these things can move very, very kind of quickly. And with that, let's bring it to oil, where this is kind of the risk of something in Iran. Oil commodity strategist does believe that if there's a conflict with Iran, that you could easily see $5 on oil to 70, 75. In such a case, then potentially I could be interested in kind of shorting it. Historically, what we have seen when we've had wars and conflicts in the Middle East, oil spikes up and then it's actually a sell. So it's a little bit of a kind of reversal kind of trade to kind of play for those of you that have the dexterity and the tactical kind of mandate to play kind of that game. So that's it for this week. Let me wish you all a very, very profitable, growth-filled, fun, and gratitude-filled week. And as always, drop me a line on any kind of questions. We will open it up to a bit of kind of Q&A and dialogue. And again, pause for